Welcome back. Today I'll be talking about stocks that I'll be adding when they get cheap enough. And besides that, we'll be talking about markets at all-time highs, as well as some questions left in the comment section below. So let's talk about the stocks that I'll be adding when they get cheap enough. And here are some of the criteria that I want from my stocks. So I want companies with amazing fundamentals. I want companies with strong brand or recurring revenues. I want capital-light businesses, as well as pricing power from the business itself. And here are my holdings for reference. A lot of these companies, they have the criteria that I mentioned earlier. But the problem with the stocks that I'm about to talk about is the valuation itself. And the first stock that I'll be talking about is FICO. So FICO year to date is down around 8%. It is currently trading at a 78 times earnings. So FICO in the US is basically a monopoly at this point. They've been granted a monopoly by the regulations itself because regulators, they want a FICO score in order for the consumers to get a mortgage score there. And for FICO, they're the standard in terms of our credit ratings. Every single mortgage in the US itself has to have a FICO score, and that is the beauty of the business itself. But for FICO, this is what I hate and what I love about the business at the same time. So FICO has amazing pricing power. If you have to look at the prices of their mortgage score from 2018 all the way until 2025, they basically 9x their prices during this duration. And this is the good part of the business. They have incredible pricing power. They can still increase prices when the housing market is weak, when the credit score volumes are stagnating or even going down. But the problem with this is it brings in regulators. So when you increase prices at such a high rate, the problem with that is the regulators will start looking. So Bill Putte, for example, your FHFA director, has been taking aim at FICO's monopoly. He's called out FICO for the price increases, and that led to the stock falling 20% about 2 months ago. And for FICO, the valuation now simply doesn't make sense. The company is trading at 80 times earnings, and just a few years ago, it was trading at around 20 times earnings. So for FICO, it is an amazing company, not so amazing valuation. It is resilient. The company has been able to grow despite of the weak housing market in the US. In fact, they've grown around 25% over the past 3 years already. I want to own this name. I can't see myself paying an 80 times earnings and a 1.5% free cash flow yield for this company. It is priced for 20% growth for at least 10 years at this price, and I think that is priced to too much perfection, especially if regulators start coming in and basically stopping FICO from increasing their prices because they are a monopoly at this point. So for FICO, I'm waiting out. This company is high quality, but it is simply too expensive today. The next company is Hermes. So Hermes year to date is down around 3%. It is currently trading at a 50 times earnings. So for Hermes, the beauty of the business is this. They promote sort of like a scarcity mindset when it comes to their bags. So they try and purposefully limit the supply so they increase the prices and increases the value of their bags. They have an amazing wait list as well. So in order for you to go in and buy a Birkin, you have to wait and wait and wait and buy other products as well. And they have incredible pricing power. So over the past 10 years, Hermes has exercised amazing pricing power. So for example, in 2019, they increased their prices by around 11%. And even this year as well, in a bad year, Hermes has increased their prices by around 4.1%. So this is a company that has incredible pricing power. And when you increase your prices, that allows your profits to grow a lot faster than the revenue itself. And another company in the same space that is amazing as well is Ferrari. So Ferrari year to date is up around 14%. It is currently trading at around 56 times earnings. So for Ferrari, the amazing part of the business itself is the loyalty from its customers. So as you can see from here, it says 81% of new cars is to existing customers. 48% of those buyers already own more than one Ferrari. So Ferrari has sort of like recurring revenue from the richest people out there. And for Ferrari, it has amazing brand value. It's similar to Hermes. These two companies are the best companies in your luxury segment. So these two companies are probably the best consumer companies out there in terms of brand, pricing power, and scale. But the question is whether or not LVMH is worth 1/3 in terms of the valuation as compared to these two companies. And that's why I can't see myself pulling the trigger anytime soon, because these companies, they're trading at upwards of 50 times earnings. When you have LVMH trading at 1/3 of that price, it is hard to justify paying up for these two companies. But nonetheless, they're great companies. When the downturn comes, I'll likely be adding into these two names. Next stock is VeriSign. So VeriSign year to date is up a whopping 38%. It's currently trading at a 34 times earnings, and it is actually one of the stocks that Warren Buffett has been adding into. So I was speaking to someone when this company was at around $190, and I completely missed out this entire rally. So for VeriSign, they have amazing metrics. So if you were to look into their gross margins, profit margins, ROIC, they're simply incredible. So they have profit margins of 50%, ROIC of 41%, free cash flow margin of 57%. These metrics over here are just stellar for any single company. And for VeriSign, this is their business model. What they do is they sell your .com, your .net, your .edu domains, and every single credible website will have a .com or a .net domain. So for VeriSign, the problem with the business is they have limited pricing power now. So they recently signed a contract with Icon to allow them to increase prices. by 7% every single year in the last 4 years. So that means that if you were to annualize it over the 6 years, the company is only growing at around 4 to 5%. So for VeriSign, it is a stable toll booth business with amazing fundamentals. The company will not give you 50% returns any single year, but it's a stable compounding machine that I missed. Warren Buffett has been buying into this one. When Warren Buffett was buying into it at the start, I was looking at it, but I decided against buying into the company simply because the company lacked growth, but the returns just this year alone are stellar for this company. The last stock that I'll be talking about is Coke. So Coke is another one of Warren Buffett's holdings. It is currently up around 12% year to date and currently trading at a 27 times earnings. So Coke is not a flashy stock to own by any means, but this company is a stable 7% every single year. And that's why if it drops to around a reasonable valuation, maybe around a 22 to 24 times earnings, I think buying this company at that undervaluation will give you decent returns over time as well. There's a company that you can just buy, hold, and wait out for the long term without doing anything to it because it is stable, it is predictable, it is high quality as well. Next portion, I'll be talking about the markets at all-time highs. So the markets are now at all-time highs again, or at least it's close to all-time highs. And from the bottom in April as well, the markets are up around 23%. So I think it's time to be a bit more cautious in the market today. And as Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. So in terms of stock market valuations today, I think the markets are on the high side in terms of valuation. The markets now are currently trading at around the 27 to 28 times earnings. And over the long time, it pays to be a bull. But it may be time to be cautious again, especially with this high valuation. Hopefully the growth is able to justify this high valuation itself. But I think with the economy weakening, this could be a headwind for the market. But if you're planning to buy and hold the index for the next 20 years without doing anything to it, then I think there shouldn't be a problem adding to it today. Last portion, I'll be talking about some questions left in the comment section. So the first one, it says, why don't you just invest in MSCI World ETF? It holds similar positions in Amazon, Microsoft, etc. Why don't I hold MSCI? Why don't I hold the S&P 500? It's simply because I don't want the companies that are lower quality in that entire ETF. And I'm not willing to pay a 27 times earnings for the S&P 500 to buy all those companies as well. Maybe when the market retraces back to around a 20 times earning, and that'll be when I'll be considering adding into ETFs. As for the MSCI World ETF, it's a similar explanation as well. I don't want the companies that are low quality in that entire ETF. Not all the companies in there are high quality, and that's why I'm avoiding this ETFs. Next portion will be on China stocks. And the first one, it says, it's the first time you mentioned about Guizhou Maotai. So for Guizhou Maotai, if you guys don't know about the company, this company is an amazing compounding machine in China itself. It's basically a legacy brand there. But outside of China, the company lacks brand power. But in China itself, the total addressable market is quite large. So if you're to look into Maotai's fundamentals, for example, the company is amazing fundamentals. It's basically a straight line up to the top right hand corner. And for Maotai, it is trading at a decent valuation today as well. And this company cannot be disrupted as well because of number one, the brand value of the company and the brand perception. And number two, it is basically impossible for you to replace the lake that they use to make all these drinks and baijiu. So for Maotai, it is a company that I've been looking at. And then the next one, it says, can you go into detail on why you consider Alibaba a good pick? And do you have it in your portfolio? So I don't have Alibaba currently. For Alibaba, the thesis will be an extremely simple one. It's just consumer recovery plus some AI growth on top of that. So the Chinese consumer have been weakening over the past few years, and it is sort of like in an inflection point from here on out. So that is one portion that could be a tailwind for Alibaba. And besides that, Alibaba also has this AI portion that makes up around 10% of their total profits. So they have the cloud segment, and they're currently the biggest cloud provider in China itself. And for China, a lot of the companies there are still not adopting cloud yet. So we could see something similar playing out in China that has happened over the past 2 to 3 years in the US itself, where your cloud companies, they've been able to leverage and grow massively because more companies are coming in to adopt cloud. So the simple thesis is just the consumer recovery in China, as well as your AI story for Alibaba. Last comment is with regards to MSCI. So the comment over here says, to piggyback a bit on this comment, in previous videos, you stated that MSCI is a buy at around $500. And another video stated that MSCI at a fair value with 10% margin of safety is around $537. Has your view changed on the buy price? Same for S&P Global, I believe your buy area was in the high 400s. It sounds like based off this video that these stocks are reasonable buys now. Yet in previous videos you stated much lower entry points. Can you clarify your thoughts here? So my typical adding process is I want to add on the way down. I don't want to add up. So for me, I currently own MSCI as well as S&P Global already. Those two companies, they make around 8% of my portfolio already. So for S&P Global, I'm looking to add at lower prices. But I think for a new investor that is freshly invested into this business, I think at $500, you're getting S&P Global at a fair price. Similar to MSCI. So for MSCI in my recent valuation video, this company is around fair value or so at around $550. which is similar to the $537 that you're referring to. So for MSCI, I think a 10% margin of safety at around $500 is more than reasonable for this company, although I think it's fair value today. And I think similar to S&P Global, this company is fair value today. So if you're interested in adding a new position into this stock, then I think it's reasonable today. But for me, I'm looking to add on lower prices. Hopefully I get them soon, but let's see how this one plays out. Hope you guys have found this one useful and invest safe.